So the stock market had another huge week as we ended out the end of April and started into May. What do you guys think we're going to see going forward as we continue to the year along? Do you think the tariffs are going to cause a huge recession, or do you think that was about as scary as it's going to get and we're just going to chug along and continue higher as things go on throughout the year?
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor, on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
Hello, my YouTube friends, and happy Saturday. Curious what you guys think. Do you think we're going to continue higher as I do? I almost think that the videos I did a while back, if I knew how to do this stuff, I'd be like, see that video right there. I was talking about the markets making new highs by the end of the year. I'm kind of beginning to think that could still be the case. Now, keep in mind, as always, it's not financial advice. You need to do your own research and reach out to a financial advisor for any financial decisions you make. But it's just my thought process. And I could see a scenario where things reverse yet again, meaning we were going higher, we reversed to go lower, now we've reversed to go higher. I could see us reverse yet again and continue back down and run into a recession and have all sorts of problems. I just feel like those things are behind us. We've had two wars. We've had threats of all sorts of things. We've had the inflation. We've had COVID. We now have tariffs. And the markets continue to chug along. And when I go out and about, places seem to be busy and people seem to be spending money. I still get sticker shock everywhere I go. And then I'm even more amazed when I look around if it's a restaurant to see that the tables are full and maybe you had to wait to get a table. My God, we went to California last weekend. We found some little Asian restaurant. I mean, it was rather expensive and we had to wait a good half hour before we could find a table on top of it. And this was not some place that's gotten YouTube or Instagram famous. This was just some place we were trying to find for us and our families to go eat. So places are still busy. I think the economy could be slowing down, so maybe we see some correction in prices. But I do think that the fear that we had 2 weeks ago was about as bad as it could get. And generally, you want to be buying from that type of fear. I know we did not have a 30 or 40% pullback in prices. We did not have a monstrous crash, but maybe that's about all we're going to see unless something changes going forward and we have some black swan event that actually makes it different. I think the news of the tariffs is already in. The company's price as if we were going to have a recession. So now if things are not as bad as were expected, I would then expect prices to continue higher. I think they've ingrained people to have these low expectations that we really don't need to do that well to have good expected to actually improve. And then think about this for a moment. And this is why I try to think like the Fed. I try to wait for the data. Earnings have been okay. Projected earnings have been okay. And they keep on meeting and exceeding those earnings estimates. So if a company like Amazon had good earnings and then guided decently and may continue to have good earnings, when everybody is preparing for a recession that may or may not come, what if it doesn't? What if the earnings just continue the route that they've been going and what they're preparing us for is actually accurate? I think the expectations have been made so low that you don't have to do incredibly well for the stocks to perform. It's the same as the Fed and why they actually wait for the data. It's a huge mistake to make your best guess based on what you think is going to happen because of things going on. You need to wait for the earnings. You need to wait for the CPI reports. You need to wait for the unemployment reports. You need to pay attention to them and see if the data is showing success or failure. And then decide from there instead of your guesses based on outside information that may or may not affect that data. People think the Fed should raise rates. Other people think they should lower rates. Some people think they're late to the party and they always screw things up. I think they're just waiting for the information to actually be accurate. And I don't think whether they make a change today or in 3 months actually impacts the economy all that much. And I think the reason that they wait for the data is it's too hard to guess what the other things are actually going to do to impact that data. I feel the same way about earnings. As Trump is talking about tariffs, I do not know that they're going to do X or Y. I do not know how they're going to impact Target's earnings or Amazon's or Google's or whomever. So I want to use their earnings and their quarterly reports and their annual reports, and if they raise dividends or what they do to make those determinations. So when a stock corrects in price based on outside information like a tariff, to me that becomes a good opportunity. And don't get me wrong, you can go back and see some videos where I was nervous too and put some cash on the sidelines, but I think that was probably a mistake. I think that you ignore the noise in the background and you continue to put away at the scariest times. Now, again, it could be quite possible that we see it reverse and start going back down, potentially make new lows and run into a huge recession. At the same time, I think that was the wrong bet to make. I think that that nervousness is about as nervous as you're going to see the markets. I hope they don't get overly optimistic and get ahead of themselves in that direction. But what if? What if the earnings just continue just fine and these companies find a way around the new regulations and rules and just continue to grow their earnings year in and year out, which is generally the case? I mean, are the tariffs going to impact McDonald's sales? And if they force them to have to be raised to raise their prices because other things start to cost too much on one end, my guess is not as much as people think, and it doesn't necessarily mean that less people start going to McDonald's. It just doesn't. And same with Nike. I think Nike under $60 a share really starts to look like an incredible bargain to me. I thought it was cheap when it got into the 70s, and the 50s seems like even a better deal. So maybe they go out of business, and OnCloud and Puma and Adidas all put them out of business, but I find that great companies find a way to get through things and generally prevail and end up doing well again. I just don't see it as this huge thing where all of a sudden there's all this competition and they'll put them out of business. I saw somebody make a comment in one of the lives I think it was Ryan's live that I was watching, and they said, they have so much competition, they're going down type of thing. They're going to be out of business. And I thought, well, are all the smash burger places that are opening up going to put McDonald's out of business? Like, yes, there's more competition, but the companies that are generally doing well tend to continue to do well. And maybe somebody emerges and starts to actually take some market share, but I still think they're still growing and continuing to increase their earnings and find ways to survive and thrive. I think there are lots of companies like that. And I actually think this pullback created some really good opportunity to look at some things that I wasn't even considering because I was much more focused on growth. I'm now seeing some dividend companies that got pushed down that seem to be making plenty of money to be able to pay those dividends that are now giving a 5 or 6% yield. That to me, I would rather take that yield, which is better than a treasury or a CD. And now I have the risk of getting a stock at a discounted price with the potential for it to go higher. Now, if I'm repeating myself, I apologize, but as always, you need to do your own research. This is not financial advice. I am just a guy on YouTube sharing my opinion. You really need to do your own research and reach out to a financial advisor when making the decisions for yourselves and not listen to me. This is just entertainment purposes. And I say that all the time. I say it a little too much. I make a big note of it, partially because you really need to do what makes sense for you. Everybody has a different financial position and picture of what they want. They have different goals, they have different incomes, they have different savings. You really need to talk to somebody or figure out what matches your specific scenario. Copying somebody else doesn't really necessarily match your goals, and either you could be putting on too big a position, too small a position, or potentially even a wrong position, depending on what you're hoping to get out of it. I mean, if you're 18 years old and just starting out in life and you take a shot on some high flyer, you got a long time ahead of you that maybe that's worth doing. And you shouldn't be listening to boring old Adam who's looking at T. Rowe Price or Archer Daniels Midland or Prudential that just isn't going to really get you the type of return over the next 50 years that you might get out of some crazy newfangled thing that your buddy told you about. Now, maybe that crazy newfangled thing goes out of business and old Adam shouldn't be investing in that because he's getting too close to retirement and shouldn't be taking those types of risks, which is why it's so important that you guys do what makes sense for you guys and not always listen to me. I hope you find interest in what I talk about. Maybe you learn a thing, maybe you don't. I love the idea of selling puts for getting into stocks and then potentially selling calls to generate more return on them. I think it's a great strategy. I don't know how many of you are comfortable with options trading. I'd be happy to explain it a little bit more because I sure hate most of the ETFs that do the covered call strategies. I hate the yield max ones. And actually, what I hate about them most is not the actual strategy. What I hate is the sales pitch. I feel like they're selling them to people who are getting close to retirement on this, amazing, you get this high return, but they really don't point out what they're really doing and the amount of risk it takes on. Keep in mind, just straight, however you want to think about it, the higher a return, whether that's in a dividend or a promise of a stock going up or whatever it is, the less likely it is to happen and the more risk they're taking on to be able to do that. Returns are basically a value of risk. Mortgages work the same way. The higher your interest rate, the more risk they see in the loan. It just makes sense. If you were the person lending money out, the more risk you see in the person you're lending to, the higher you need to get paid in order to make that loan. I look at stock investing the same way. If I'm going to lend to NLY, because I heard somebody talk about it recently, they have a pretty high starting yield. Well, in my mind, when I buy the stock, I'm lending them my money or I'm lending the stock market that money to get that high yield. Why am I getting that high yield? I haven't dug into it deep enough, but they are taking on some sort of risk that's a pretty high risk to try to make those payments. And it may not work out the way they hope, and they may either have to cut those payments or the stock price continues to go lower. I shouldn't say continues. I haven't really paid that close attention to it. But same with anything that's paying a really high dividend, they're taking risk to be able to do it. And that's kind of what those yield max funds do. To be perfectly fair, I don't mind a covered call strategy. I really don't. I use it for my own portfolio. I'm just more comfortable doing it myself. Because the other thing I don't like is to try to give those high yields, they are doing it on leverage. They are not actually buying the stock. They're buying a call and selling a put, which synthetically puts on the stock because no matter which direction the stock goes, you are either being allowed to, or you're being forced. Either you're being forced to sell the stock as it goes higher, or you're being forced to buy the stock as it goes lower, which is why you're synthetically long the stock. They then sell some calls against their synthetic long to be able to try to collect a premium in order to pay what they don't call it a dividend. I think they call it a distribution because it is not an actual dividend. Then if the stock goes lower, they are long, but they've just collected whatever premium they have for selling those calls. If the stock goes higher, they're forced to sell their stock because they've sold a call against their synthetic long. It limits your upside, giving you full exposure to the downside, where the only way you really outperform the market is in a down market, and you're pretty much guaranteed to underperform unless the stock just sits at the price it's at and has some unusually high volatility, so you're actually getting paid really well on the calls you're selling. It's why I'd rather take control of it myself, make my judgments on when I think a stock is inexpensive or when I think it's moved a lot, and maybe the volatility in my mind is high for a certain stock. So I look to sell the puts or I look to sell the calls to capitalize on the high volatility. I find earnings is a good time to be able to sell options for that exact reason. I'm just comfortable if the stock spikes way higher and I'm forced to sell my shares. I'm okay with that.